This is Barry Zalma on insurance. I'm an attorney who is retired from the practice of law and now spend my time as an insurance claims consultant and expert witness and author and producer of these videos. Today I'd like to speak about the use of the term moral hazard and how it is applied to underwriting insurance policies. The moral hazard is defined as the increase in uncertainty caused by personal acts of individuals. These acts may contribute to the probability of severity of loss. The individual creating the problem may be the policyholder or another person. In either case, the chance of loss is increased. A moral hazard may be present in every line of insurance. No underwriter can ignore it without incurring an increased risk of substantial loss. The moral hazard is very difficult to detect and therefore very dangerous to an insurer. Underwriters use the term moral hazard to denote the incentive that insurance can give to an insured to increase the risky behavior covered by the insurance. The competent underwriter and an adjuster recognize that moral hazard describes a policyholder who deliberately causes a loss by, for example, 1. Setting fire to his or her building or automobile, 2. Conspiring with thieves to steal his or her cargo-laden truck, 3. Making false entries in his or her accounts in order to justify a claim for non-existent property, or 4. Reporting a burglary that never took place at his or her home or business. There are many other examples, but these pretty much set forth what a moral hazard is. Some underwriters think only of the intentional fraud when they use the term moral hazard. If an applicant reveals such a fraudulent intent, no sane underwriter would agree to insure him. It is for the adjuster to discover it and warn the underwriter against maintaining the risk in the future. However, most moral hazards are not of this deliberate type. There are many cases when the attitude of the policyholder has increased the hazard without any thought of a deliberate act. The moral hazards described can be controlled by an effective and knowledgeable underwriter because no fraud perpetrator would put in an application, "I intend to set fire to my house," or "I intend to fake a theft." The moral hazard is never that obvious. In West Virginia, the Supreme Court of Appeals concluded that a fire policy provision making a policy void if the insured has other insurance was not permitted, because moral hazard should not be increased without an insurer's knowledge. The term moral hazard refers to the incentive that insurance can create to intentionally commit the act insured against. Since the cost is shifted to the insurance company, the person insured creates a loss to profit from the insurance, something anathema to the concept of insurance. An example is the incentive to burn down one's house if the house insured is insured for more than its value to the owner. Moral hazard refers to the effect of insurance in causing the insured to relax the care he takes to safeguard his property because the loss will be borne in whole or in part by the insurance company. In this country, the dominant public policy underlying the rule requiring a person insured to have an insurable interest in the property is to eliminate a form of moral hazard, Someone without an interest could care less about its destruction. Insurance policies that compensate beneficiaries upon the destruction of property that the beneficiary does not have an interest in preserving give beneficiaries an incentive to destroy the insured property. Arson for profit, in my opinion, the most evil form of insurance fraud. Property is destroyed, people are injured or killed as a result of the arson-caused fire. People who work together to defraud insurers by means of arson-for-profit schemes have unmitigated gall, have no moral compass, and are dangerous to anyone near the property they destroy. When caught in a conspiracy to commit arson for profit, the unmitigated gall, the chutzpah of the criminals usually result in a trial, and if convicted, an appeal. For example, in United States of America versus Shirley Denise Burke, a 2018 decision of the 11th Circuit, after conviction, the inevitable appeal happened and the 11th Circuit, with detail, resolved the claims. The 11th Circuit refused to fall for the arguments posed by the defendants after their conviction. It recognized that the circumstantial evidence establishing the conspiracy to commit arson for profit was overwhelming. Arson is an evil crime, and it took the government a great deal of time to catch these conspirators, and their convictions and sentence to prison may and hopefully should deter others from attempting the same. Liability insurance policies often contain an exclusion for claims brought by one insured against another insured. The exclusion serves to limit moral hazard. Without such an exclusion, a policy could require the insurer to pay for the business mistakes of its insured. Parties insured under the same policy would have no disincentive to sue one another, since only the insurance company would ultimately bear the cost of the judgment. This sets up what is known to economists as a moral hazard, because the party taking the risk will not bear the costs of its wrongful or negligent behavior. The exclusion counteracts that problem by eliminating the possibility of a third party's subsidization of such a lawsuit. Suits in which a corporation sues its officers and directors in an effort to recoup the consequences of their business mistakes turns liability insurance into business loss insurance, which was not intended by the insurer. A variation of the moral hazard is lack of self-interest or morale hazard. There are cases where the ownership of the property is less desirable than the proceeds from insurance. One example is an outdated building situated in a business area with a high concentration of business and a shortage of parking space. The owner might receive rent from tenants but could receive more if the building was raised and the land used as a parking lot. Under such circumstances, there may be a temptation to start a fire, or, in a morale hazard situation, at least doing nothing to avoid taking steps to prevent a fire. Similarly, the person who is unable to meet the payments on a loan and is faced with foreclosure can present a moral or a morale hazard. The property may not be saleable at a price high enough to repay the loan. The policyholder may fear a lower credit rating if foreclosure begins. When any of these conditions exist, there may be a temptation to sell the property to the insurance company by means of a total loss. If one's financial well-being would be enhanced by the loss of property rather than its preservation, there would be a temptation to destroy the property, or at least to take reasonable precautions to protect the property. This moral or morale hazard arises whenever one can obtain insurance company coverage on property for more than the property is worth to the insured. Given current societal attitudes towards gambling, the moral hazard concern appears to be a stronger peg on which to hang the insurable interest doctrine. A moral hazard is a risk, danger, or probability that the insured will destroy the insured property for the purpose of collecting the insurance. For example, when an insured's classic 1960 Thunderbird was stolen, the owner attempted to convince a California court that his actual cash value policy was in fact a valued policy. In Andrew George versus Automobile Club of Southern California, a 2011 decision of the California Court of Appeal, George filed a class action complaint against his automobile insurer challenging its alleged practice of identifying a specified amount as a vehicle's actual cash value, in plaintiff's case $25,000, in the insurance policy, but then refusing to pay that amount in the event of a total loss. Mr. George's attempt is an example of why valued policies are seldom written in California, but are written in other states and present a moral or morale hazard to those insurers who issue valued policies, where in the event of a total loss, regardless of the value of the item actually destroyed, the insurer is obligated to pay the policy limit. Mr. George was upset that the insurer would only pay the fair market value of the car at the time of the loss, because California defines actual cash value as fair market value at time of loss unless otherwise defined in the policy. The appellate court concluded that George's allegations would render the operative provisions of the policy nonsensical. George's interpretation would also render meaningless the provision of the policy in which the parties agreed in case of a total loss to appraisal provisions and procedures for establishing the amount of loss subject to the insurer's liability limit. Such a procedure would be entirely unnecessary if the insurer had agreed, as George claimed, to payment of $25,000 irrespective of the actual value of the car at the time of the loss. California, since the Supreme Court ruled in Jefferson versus Superior Court in 1970, the term actual cash value has been synonymous with fair market value. As a result, some insurers define actual cash value in their policies and others do not. Those who do not accept the Supreme Court's holding and adjust claims based on fair market value, Mr. George was therefore entitled only to receive the fair market value at the time of the loss up to but no more than the limit of liability of the policy. Underwriting decisions, that is, whether to insure or not insure an applicant, are based upon the assumption that the record of the past will continue into the future. When the underwriter looks at the character of an applicant, he or she assumes that the character will not change in the future. If an applicant shows that he or she has resorted to questionable acts in the past, it is likely he or she will do so again in the future. The most obvious example is an applicant who had one or more questionable insurance claims. Arson for profit is difficult to prove, and allowances are made for coincidences in order to avoid prejudging a person, but the claim may be on record as a questionable one. A record of questionable non-insurance transactions in the past would also provide a clue to the character of the applicant. The underwriter who ignores an insured's history will likely cause the insurer to pay for the repetition of it. For example, a criminal conviction for a crime of moral turpitude like fraud, embezzlement, theft, burglary, or misrepresentation is an adverse underwriting indication. And when an insurer agrees to insure a person against a risk of loss to real or personal property, it is promising to put its money in the hand of the insured. No reasonable or prudent person would put his or her money in the hands of a convicted felon without taking exceptional safeguards. When an underwriter is concerned about the potential of a moral hazard, when there is a potential of increased risk, the underwriter can protect the insurer by adding serious exclusions to the policy, by adding conditions that would require more detail from an insured in the event of loss, and by increasing the deductible or self-insured retention amount to the point where the insured has as great an interest in a potential loss as does the insurer. This video was adapted from my book Zelma on Insurance Claims Part 102 Second Edition, which is available as both a Kindle book and a paperback from Amazon.com. If you found this video to be of use to you, please refer it to your colleagues. It's free, and please subscribe to my YouTube channel, my Rumble channel, and my blog so that you can learn about future videos and future blog postings. Thank you for your attention.